Hello, accounting students. We are currently working on lesson 3 in chapter 11. Remember, chapter 11 is all about accounting for transactions using a general journal. And lesson 3 in this chapter is about accounting for the declaration and payment of a dividend. So the learning objectives for this particular lesson explain the relationship between retained earnings and dividends, and then account for the declaration and then the subsequent payment of a dividend. So one thing we probably want to think back to is in the first part of the book, we were dealing with a sole proprietorship. And so whenever the owner wanted to take money out of the business, the owner would use the drawing account. Well, because corporations have stockholders and many stockholders, it isn't really reasonable to have an owner's equity account per se, or a drawing account like we did with the sole proprietorship. So the corporation does not have a drawing account for each owner, each shareholder. Instead, what you see for accounts would be a capital stock account, retained earnings, dividends, and then your income. So these are the stockholder equity accounts that would be used by a corporation. Okay, so as you think about some of the vocabulary that's in this particular lesson, retained earnings and dividends are pretty common. So when a company has profit, this is amount that's earned by the corporation, and if it stays in the corporation, it's retained earnings. And some corporations choose to leave the money in the business, and they use the money or the retained earnings to expand, to develop, and to really invest in their business. Sometimes, though, businesses or corporations decide to pay out earnings, and when earnings are paid out, that's what's called a dividend. Now, a company's board of directors, that's the group that's responsible for governing the actions of the corporation. They might decide to declare a dividend. And so the board of directors, they govern a corporation, and they would decide what is going to be done with the company's earnings or their profit. So when the board decides to distribute corporate earnings, or distribute the money, the profit that the company has earned, it's called declaring a dividend. And one thing that you would want to keep in mind is that dividends are typically declared on one date and then actually paid out on a later date. So sometimes what happens is a company will declare a dividend, say on the 10th of the month, and then they will tell you that we're going to pay out that dividend on the following month on the 10th. So typically you do see some time lag between when the dividend is declared and when it's actually paid out. Now, you want to be aware of the fact that once it's declared, it's now a liability for the company, as it's something that they'll have to pay out. So on December 15th, 3 Green's Board of Directors declared a quarterly dividend of 5 cents per share. Capital stock issued is 75,000 shares. So the total amount of the dividend is $3,750. The date of the payment is going to be the following month, or January 15th, and we're going to use memorandum number 43 for this. So you can see that we are going to go ahead and debit dividends, so increase dividends, and we're also then going to credit and increase dividends payable. So as we look at our general journal entry here, again, it's December 15th. The account that we're going to debit is dividends. We're using our memorandum 43 to put this in our general journal, and the account that we're crediting is dividends payable. Again, it's going to be a liability, so it's something we have to pay. Then we can, in January, we're going to actually pay this previously declared dividend. So we paid cash for the quarterly dividend. So when we look at our dividends payable, you can see that our cash on the January 15th is going to be our credit, and our dividends payable is going to be a debit. Okay, so as we look at our cash payments journal now, because remember we're recording cash payments, on the 15th of January, our dividends payable check number 742. The debit is $3,750, and it's a debit on our general journal, and it's a credit to cash. So as we think about auditing our understanding, under what major chart of accounts division are the owner's equity accounts for a corporation normally listed? So where are we going to put those? Those go in the stockholders' equity. Why is only one account maintained for the investment of all owners of a corporation? And I mean, I would just say there's a lot of stockholders for most corporations, and it just isn't practical or reasonable in any way to keep a record of all of those stock owners. Which account does a corporation use to record earnings not yet distributed to stockholders? So you would think about this earnings not yet distributed. That's retained earnings. That's the money that the company chooses to leave in the business. How and when do net income and dividends impact permanent stockholders' equity accounts? At the end of a fiscal period, temporary accounts are closed to retained earnings. Net income increases retained earnings, and dividends reduce retained earnings. So when a company has net income, it increases the retained earnings for the company. When they decide to pay out dividends, so they're paying out that income that the business generated, that actually reduces the retained earnings. What action is required before a corporation can distribute income to its stockholders? Remember, that group has to get together, the board of directors, and they have to declare a dividend. All right, lesson 3 was fairly short, so you're going to want to go ahead and do the form, work together and on your own, and then from here you should go out and do all 3 application problems before you proceed to do any Challenger mastery work. Good luck!